Welcome back to the channel. My name is Brian Johnson, and today we're going to be discussing the phenomenon known as the 90-90-90 rule. Now, if you've never heard of this rule, this is where 90% of the people lose 90% of their money within the first 90 days of investing within the stock market. And on this video here, we're going to show you how to mitigate that risk and not become a statistic. Now, the numbers that I just read up to you may sound a little alarming, but it's imperative that we understand the context and the factors that go ahead and contribute into this 90-90-90 rule. So let's go ahead and take a deep dive into this rule, and hopefully we can help you not fall into this category. What are factors that contribute to this 90-90-90 rule? So the first one is going to be your ability to control your emotions. Now, your emotions are very real, but they will contribute into this system here. And as we all know, emotions can be volatile. And if you watch the market every day and you watch those fluctuations, you know, the market's going up, it's going down, it's going higher, then it goes lower. You know, it may trade flat. You never really know what the market is going to do on a day-to-day basis. But investing in the market, you will learn a lot about yourself and to know if you can actually control your emotions. Now, like I said, these emotions, you know, as we see it going up, you know, we may get greedy, which you don't want to do in the market because you can lose your money, especially if you're investing into a stock that you have no knowledge about. You just kind of, you know, see everybody else jumping into it, like GameStop. We all know what happened there. It shot up. It was a meme stock. And then, you know, people started putting money into it without knowing the fundamentals of it. They just thought we were making money. And then it tanked, and a lot of people lost a lot of money. So, you know, just take into account your emotions will heavily determine, you know, how your decision making goes. So that's the kind of the first thing with dealing with this 90-90-90 rule and not losing money. Next up is your ability to manage risk. Now, risk is a major contributing factor into this statistic. Some investors, you know, will diversify their portfolios so large because they're trying to avoid the risk of, you know, putting all their eggs into one basket. Well, you know, this can have an adverse effect as well on you when you're investing because you can over diversify to where you make no money or you lose a lot of money during certain economic downfalls or uptrends. And, you know, so managing that risk by doing your research on stocks, and you don't have to diversify your portfolio across 30, 40, 50 different stocks, you know, just a good handful, maybe 5 that actually, we don't want to diversify, we actually want to integrate these into our portfolio by knowing exactly what we're investing in. So when you're investing, managing your risk and having a clear exit strategy will help you so that way you don't lose a lot of money. And so a lot of these concepts I want to mention here, you know, you might not know about, but as you get further into your journey, you'll understand these. So you want to put like a stop loss on your, you know, your stock when you're investing. So if it hits a certain mark, you know that that'll allow you to get out of that stock without losing any money. And as the stock price rises, then you can also raise your stop loss on that. All right, so now that you know what these factors are that contribute to you hopefully not become a statistic, let's go ahead and discuss some strategies that can help you mitigate these risks and improve your chances of being successful when investing into the stock market. First thing here on how we mitigate our risk and not becoming a part of this 90-90-90 rule is to educate ourselves and do research. So with this here, with this research here, we want to understand the financial concepts as we do our studying on these different investment strategies. Read books, take courses. Also get the help of somebody who has been doing this a while. Now, I'm not a financial advisor, but I can show you guys how to invest your money into the stock market and make money for yourselves. So that's what we do here at Nexyz Capital. The other thing that you want to do is, like I said, besides the courses, the books, the technical analysis, just, perform the research on the actual company itself. Get to know who the board of directors is. Get to know who the CEO of the company is. I mean, the CEO is always the face of the company, but know how that person reacts in times of lean times and in times when our bellies are nice and full on the stock market going up. So educate yourself, do your research on these companies. Don't take everybody's recommendation on a stock. If you get a hot stock tip, leave it alone. It's too hot for you. It's fire. Don't touch it. Nobody else is touching it. Like I said, GameStop was one of those where people touched a hot stock meme and they got burnt. So do your research, get your education before you actually jump in and start investing into the stock market. All right, step 2 in this process is we are going to create an integrated portfolio. Now, what do I mean by an integrated portfolio? So we are going to do the research on these stocks first, and then we're going to find the ones that we actually understand and that meet our criteria for investing into. We're not just going to pick a handful of stocks to diversify into just because our next door neighbor told us to. No, we're not going to do that. We're going to strategically pick these stocks and that they actually meet our criteria for investing. Now, these could be single stocks, these could be ETFs, but like I said, we are going to educate ourselves on each one of these, make sure that the people behind the companies, because there are people behind these companies, they're not just numbers, actually have the emotional stability themselves to make the decisions that they're going to move the company forward. Why? Because we are not actually insiders in these companies. They don't call us up on the phone and say, hey, Brian, I'm making this move in this stock today. Why? Because we're not on the inside. We're on the outside and we're waiting for their numbers to come back. So we need to make sure that they're competent and that we get to know these people, doing your research on them before we actually invest into them. So first up, we're going to educate ourselves. Then we're going to do the integration of the portfolio. All right, step number 3 is going to be your risk management. As well as planning. Now, you're going to set a realistic goals for yourself in this step here. And the reason why I say that is because you don't want to overextend yourself in investing to a point where you're actually starting to lose money. And your risk tolerance level is super high, especially if you're just beginning. Like I said, we're in these first 90 days. So you want to make sure that you know yourself and your tolerance level for investing into the stock market, and know how much you're actually willing to invest and lose on these stocks. So if you're not willing to lose any money, let's say you're investing in a stock and it's $10 and it drops down to $5. Well, how do you feel about that? That's a part of this risk management here. So you need to know that going into it, that yes, you can lose money in the stock market, and hopefully we limit those losses for you. So reach out to us and we can discuss, a plan on getting you started in managing your risk in these stocks and learning how to do the research on these stocks and before you actually decide to put your hard-earned money into these stocks. So that's going to be your risk management in the planning stage when investing into the stock market. All right, lastly, step number 4 is we're going to have a long-term perspective on the market. A long-term perspective. Now, this means holding your stocks for a minimum of 1 year. You can hold them longer, but the minimum is going to be 1 year. And the reason why we do that is so that we can lower our tax bracket. And we all want to lower our tax bracket. So when you jump into the market, here's your 4 things. Now, also with that long-term perspective, as we know, there are ebbs and flows in the market. It goes up, it goes down. Right now, we are potentially, I'm going to say potentially because nobody's calling it, we're going to be potentially in a recession. Now, as we all know, in a recession, things get depressed and the stock market falls. So we want to make sure that we hold our stocks through that recession and give them time to recover. We don't want to sell for a loss, which could happen in this bear market situation. So we always want to make sure that if we do decide to sell our stocks, that we are going up on an upturn. So having that long-term perspective will help you achieve that goal. Once again, you want to do your education and your research. We're going to integrate the stocks into our portfolio. We're going to have our risk management and planning. And then we're going to have a long-term perspective when investing into the stock market. Now, I know I mentioned this year, this 90 days, 90% of the people, you lose 90% of their money. And I know for some of you guys that can sound discouraging, but don't let that discourage you into not investing into yourself and into your future because you are trying to build up your lineage, not for today, but for down the road. So remember that with the proper training, knowledge, you can actually mitigate these risks of investing into the stock market. So that way you will have a much improved chance of actually succeeding when you invest your funds. So that's going to be it for today's video. I hope you took something away from that. Don't forget, subscribe to the channel. We greatly appreciate that. Hit the like button, comment below, let a friend know about the channel. And until next time, be safe and happy investing.